Hello and welcome to Livewire Markets. My name is Chris Conway. Today I am sitting down with David Elms, who is the head of diversified alternatives at Janus Henderson. David is going to be talking to us about the current market conditions in the context of the Janus Henderson Multi-Strategy Fund. David, it's nice to see you.
Thanks, Chris. Thank you very much for having me here.
David, the investment philosophy for the fund touches on investor constraints, behavioural biases, structural inefficiencies and capital flows. Can you just talk us through these and how they create opportunities?
So these are all examples of tailwinds for a strategy that essentially create the opportunity for us. They're broadly market inefficiencies. A good example is our trend following strategy, which rests heavily on behavioural inefficiencies. So the idea in a theoretical economic world is there's new information and prices immediately adjust for the new information. In the real world, prices adjust slowly as different people become convinced about the information. So this is an example of a behavioural inefficiency, the fact that there's not instant dissemination of information in prices as soon as new information comes out, and it's what enables a trend following strategy to work. The other examples are somewhat similar. Capital flows, for example, in order to encourage people to take the other side of a capital flow, like a large block trade where a shareholder is trying to sell shares in a company, you need to have a discount to the price to encourage people to come in. And this is the underpinning inefficiency that drives our price pressure strategy.
Right. David, before we talk about how the multiple strategies you run in the fund plug into the world, I just wanted to get your take on the world as we currently find it. There's plenty going on. So the Trump-induced trade tariff wars, how are you seeing that?
It's very hard to say. I mean, at the time that we're talking, they've been on again, off again, and on again.
Yep.
And I think this is evidence that nobody really knows, maybe not even the administration itself, how this is going to play out. It's a complicated negotiation. We're not quite sure what the objectives are. So I think it creates noise, it creates volatility. This creates opportunities. It also creates the potential that the market will cease to pay attention to it, and this in itself is another opportunity, because I think sooner or later somebody's bluff is going to be called, and they won't just be talked about, they'll actually land, and that will have a significant impact on the real economy, and in advance of that, in anticipation of that, on security prices.
What about, David, inflation as it relates to fixed income? A little bit more stable there?
My personal view of tariffs is they're likely to be inflationary. They're going to increase the prices of imported goods, increase the prices of the components of goods that use imports in their manufacture. I think to some extent, the recent movement in fixed income prices has anticipated the inflationary impact of tariffs. But going to back to what we were just talking about, there's so much noise, so much uncertainty. Maybe that hasn't been anticipated enough. And if the market is not fully baking in that inflation now, it will have to bake it in the future, and that manifests itself in lower fixed income prices.
David, what about equity market valuations and concentration? It seems like we're seeing that concentration risk grip markets right before our very eyes.
Maybe over the last 6 or so weeks since the market, and I'm talking here generically, the US market topped, the fall in the market has been led by the mega cap names, the Magnificent Seven. So concentration is less of a problem than it was 6 weeks ago, but it's still a significant issue. The markets are concentrated. Global equity markets are heavily concentrated on the US, more so than at any time in history. And then the US revolves around a small number of similar names, the Magnificent Seven. So this creates opportunities. That's good for what we do, but it also means that the market has risk embedded in it as well as a consequence of that.
Last one, David, I know it's quite broad, but volatility in general.
I think volatility in general is likely to move upwards. So the policy uncertainty that we talked about with regard to tariffs, more concentrated markets, the risk of inflation, all of these things lead towards potentially higher volatility, and then overlay on top of that geopolitical uncertainty. So it's very hard to know where things are going to go with Ukraine, where things are going to go with sanctions, with European rearmament. But this geopolitical uncertainty sooner or later translates to higher volatility as well, as it did back in 2022 when the Ukraine conflict first burst onto the scene.
Yeah. David, is there anything that I have missed? Is there any other key themes that you're paying attention to that you think investors need to be aware of right now?
I think one of the big themes that's important in markets right now is the correlation between the two big building blocks of portfolios, that's equities and bonds. And for most of the last 20 years, that correlation has been negative, so bonds up, equities down, vice versa. And this means that portfolios are more stable because the big components offset each other. Now, if, as we just talked about, we move into more inflationary times, this is characterized by equities and bonds going up and down together, and this means that portfolios are less stable and they need another building block in that era where there is less stability. And I think that building block is a building block that is not correlated to equities, not correlated to bonds, and alternatives in general fit that bill.
David, you've given us a great view of how you're seeing the world. How does some of the strategies in the portfolio plug into those views? Can you give us some examples?
We run 7 strategies. We run 6 that we call risk-on strategies, and they're designed to perform in normal market conditions, whether markets are up, flat, or down. And some of those benefit from, equity concentration. We think that creates interesting opportunities in our equity market neutral strategy, and we've spent some time setting that strategy up recently to have more exposure to individual names and less factor exposure. So in general, more turbulent times, more dispersion in equity performance makes it a better environment for strategies like equity market neutral. However, I said we have 6 risk-on strategies. We have a 7th strategy, which is called protection. Protection is designed to deal with surges in volatility. So it employs strategies like trend following that tend to do well if markets move a long way in one direction or another. And it employs option-based strategies which do well when volatility goes up. So we talked about some of the things that might cause volatility to go up. And in that environment, it is likely that our protection strategy contributes positively as well. So a good example of that was back in August 24, when we had the deleveraging in the Nikkei at the beginning of August, and our protection strategy, the volatility side of it in particular, did well in that environment.
David, what about the convertible arbitrage strategy that you are close to? How's that performing?
Convertible arbitrage has been a strong strategy. In hindsight, I wish we'd put more money to work in the strategy because it's done well for us. I think the thing that's changed with convertible arbitrage is the mix of investors that buy that strategy. So the strategy's moved from being predominantly driven by long-only investors who are relatively price insensitive. If money comes into their funds, they buy convertibles, whether convertibles are cheap or expensive. The strategy's moved to being dominated by hedge funds, and in particular, multi-strategy hedge funds like us, that tend only to buy when valuations are attractive. So if you have more valuation-driven investors, prices stay more reasonable, and the returns of convertible arbitrage tend to be driven by how cheap the convertible bonds are when you put them in, and price-disciplined investors create more opportunities that way.
David, I just want to zoom out a little bit. Most retail investors struggle to manage 2 or 3 strategies. There's 7, like you said, in the fund. So how do you manage that from both a resourcing perspective, but then also how do those pieces fit together as the world is changing around you?
So it's a challenge, and it's one of the challenges of multi-strategy investing. But the idea of multi-strategy investing is that you can take a broad range of investment strategies, allocate risk across them in such a way that you're not overly exposed to any one strategy as a point of failure. So we do this. We have a reasonable sized team. We have 24 investors, and we have strong technology. So I think a combination of depth of bench, experienced investors, strong technology lets you manage that complexity. But you're absolutely right, it's a challenge. But if you can get it right, that's what multi-strategy investing is all about.
David, given your view of the world, which strategies do you think will be towards the top of the pack over the next 12 months, be potentially the best performers?
Always a difficult question.
Yeah.
So I think we have two polar extremes. We have an extreme where volatility overflows, as we talked about earlier, and I think in that sort of environment, it's nice to have a backstop like a protection strategy. So if we see a chaotic unwind of high valuations, or we see an unexpected spillover of geopolitical tensions, then we think our portfolio has that backstop that is likely to stabilise returns. So in that scenario, I can see a protection strategy working well. If I was looking at a more normal environment where standard assets are within their historical ranges, then I think right now our risk transfer strategy is likely to be the strongest. It's the one that we have the biggest risk allocation to right now, and that's reflective of the way we see its prospects.
David, you've touched on the portfolio protection a number of times. Can you just explain a little bit more detail how it works in practice? What tools are you using to protect the portfolio?
So I guess you can think of it a little bit like a Russian doll. You open it up and there's something else inside it. So we're multi-strategy at the top level, 7 strategies, but you open up protection and inside it there are 3 sub-strategies. So we run a trend following strategy, and trend following deals well with environments like 2022, when asset markets moved in an adverse fashion, but consistently over time with those trends being set up and materialized. We run a volatility strategy, and what that means is options, and options are very good at dealing with sharp moves. So whether that's COVID in 2020, which appeared very rapidly, or roll back further, 2011, Fukushima in Japan, the tsunami, and that literally appeared from nowhere. A volatility-based strategy with options can deal with those sharp changes where you have little warning, if any. So that's the second component. The third component is discretionary macro implemented with long convexity. And that again means limited downside structures like options, but that are positioned to hedge risk concentrations in the rest of the portfolio and informed by macro views. So opening up protection, unpacking it, 3 separate sub-strategies designed to protect the portfolio in different scenarios. So in the same way that we diversify our risk taking across 6 risk-on strategies, we diversify the protection across different components as well.
Fantastic. David, thanks so much for sitting down with Livewire and taking us through that.
Thanks, Chris, for having me on.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.